Thank you, Dave, and good morning, everybody. Price Headley here from BigTrends.com. Thrilled to be with you. And we've got a variety of option strategies for traders. Bottom line is that one of the most popular ones, because it basically encompasses all of the market leaders, all of the AI and other key drivers of the market these days, is the NASDAQ 100 QQQ. And that's what I want to focus you on today, is how you can get your focus back. Start focusing on just one key symbol at a time. We think the Qs are one of, if not the best, to get that focus. We're going to talk about the percent R indicator. Larry Williams developed that, along with the ATR indicator developed by Wells Fargo, which is more of a volatility calculation we use to determine what's the right option to buy in given environments. Obviously, the markets have been more volatile here recently, right? So that extra volatility means that it affects option pricing. We're going to get into that, but before we do, let me remind you the information provided in today's presentation is based on our proprietary research, and it's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but let's face it, they also have large potential risk. The past performance of any trading system or method is not necessarily indicative of its future results. Do see our terms of use on the BigTrends.com homepage for more information here. So if you don't know me, I've been trading options for 36 years and counting, almost 37 in April next month. Bottom line is that it's always been about a systematic approach. Okay, so basically systematically looking for when to execute, when to get in, when to get out. So what you can't allow yourself to do, even when you get more experience, is to think you know better than the system, you know more than the market. The easier way to go, and frankly the smarter way to go, is just to stay systematic. So that's what I'm going to focus on, is our QQQ option system here today, looking at how we've been doubling and sometimes more on gaps, and basically, of course, not every trade is going to double. So we're going to walk you through when it doesn't double, when it has a smaller gain, break even, or a loss. What do you do in those scenarios as well? Walk you through a bunch of success stories, chart examples, as well as show you how you can take advantage of a short-term trial period that basically will allow you to check out the QQQ options playbook system itself. Now, when we talk about the Qs, we're talking about NASDAQ 100. We're talking about driven by names like NVIDIA's at the top of the list, right? NVIDIA has become the biggest stock in the markets today because of its AI dominance, its chip leadership. That a lot of chips are going to be needed for this AI era that we're moving into. And so bottom line is, of course, you've also got Apple, you've also got Amazon, you got Meta, you got Microsoft, and more. And so basically, the key is also, we're talking about high liquidity, right? These are the ones that the institutions want to own when they want to get in. Oh, by the way, when they want to get out, it's also the ones that they sell for the fact that you've got tremendous liquidity, ease of getting out when you want to get out or rotate into something else. So get a ton of action there. By the way, the options market on these, some of the most active options are these individual stock names, in addition to the Qs themselves being super active, because the Qs actually have every single day expirations. So that's one of the really attractive things to me, is we can really customize our strategy to only buying as much time as we think we need, and not a whole lot more. So at the same time, we're never going to hold it into an expiration day. So I'll walk you through how this works. Look at that, averaging over 70 million shares a day. And of course, we're going to talk ATR. What is ATR? The average true range is basically looking at the high-low range, but also including gaps. So as we said, this recent environment's been higher volatility, and in turn, the Qs tend to have more movement than the S&P, than the Dow, than a lot of other major averages. So, and again, very ideal for systematic trading. Now look at this top 10 holdings list. This was pulled back a month ago or a month and a half ago, but basically you see that NVIDIA, the top holding, about 9% of the QQQ NASDAQ 100 is in just NVIDIA, right? So you say, how's that possible? Why isn't it 1% a piece? It's capitalization weighted. So when you start to see stocks become bigger, then in this case, they become a bigger part of the portfolio. So big winners like NVIDIA, Apple at 7.5%, Microsoft 6 2/3%, Amazon 5%, Tesla almost 4%. The interesting thing on Alphabet is you got to add the two Alphabet Class A and C shares together, and you get up over 7% on Alphabet, then Meta at 3%, Broadcom at 3%. And then Costco, your first name that's non-tech, at 2%. So right away, about 46% of that top 10 of the whole index is key tech and AI names, right? So the idea being that you want to make sure that you are benefiting from this AI and tech wave. So you could trade shares on the Qs themselves, but for us, the QQQ options playbook strategy really takes it to the next level by leveraging signals on the Qs with options trades. We keep it simple. So let's go into it and start by with a winning trade example. And we've got daily candles here, okay? So we're looking back here through this past month in February. And what we've got on the bottom panel, we look at a combination of the indicator. The bottom panel in blue is the Larry Williams percent R indicator, okay? So percent R means percent range, okay? So percent R means, okay, what's the recent range been? Now we look at usually a little bit longer time frame than even this chart covers. When you become a subscriber with a special trial offer we tell you all the settings that we tell long-term subscribers as well. So you learn the system while you're looking to earn from it. But basically, even on this chart, if you're looking at the recent low, it was 593 and change. If you were tracking it on a shorter term percent R, you would track back to that high, which is up around 616. So you measure the high to low range, and you see that you're at about a 23-point range. So if you look at where we're closing at when we get a breakout to say the highest levels, that would push us up to 100%. Now in this case, it's not that high yet because of course the market had been correcting and the Qs have been going sideways. And so what happened is the percent R levels actually came down, you can see on this one, into about the 20th percentile, the relative low area of the range off of that 593 low, right? We were finishing that day in the neighborhood of about 601. And so from this perspective, you look at this and say, okay, at 601, what do we do? That was on February 23rd. Okay, so basically what we recommend is we'll go back and look at recent volatility trends. If we've had a little bit more volatility, we'll usually actually recommend going a little bit closer to the money, ironically, and paying a little bit more for each option contract. So in this case, we got in for an average entry price of $5.25, meaning got to multiply that times 100 because each option contract you purchase controls 100 shares of the Qs. 525 bucks on one contract controls 100 shares of the Qs. It would cost you just over 60 grand, right? So you can see your theoretical leverage right away is approaching 100 to 1 if you get an instantaneous move. Obviously, we have time risk in these trades, right? That's one of the things you've always got to recognize is that when you buy an option, you're going to pay some form of time premium. In this case, it's all time premium, okay? So we've got to have a plan for how we're going to not just get into this trade, but also how are we going to get out. So what we're doing in this strategy is that was called out on a Monday afternoon. We put these trades out in the last half hour of the QQQ options trading, which actually the QQQ options will trade until 4:15 p.m. Eastern time, Wall Street time. So on that Monday, we're buying the Thursday expiration options that will expire Thursday afternoon, February the 26th. So, okay, why are we buying that short term? Because we're looking for quick pops, and we're also knowing that we will not hold it into that February 26th expiration date. The latest we could hold this trade would be the end of the day on February 25th, the day before. Okay, so we're not trying to trade the 0 DTE, 0 days to expiration. This is 3 DTE when we start these trades off, 3 days to expiration. And what I always remind new subscribers coming in too is that, look, start small and build. Okay, so basically, if that seems like a risky strategy to you, A, you could watch it first, but B, when you do start trading, you could trade one contract at a time just to get the flavor of, okay, how's your 525 bucks going to do? If we hit our target, which is a double, can make 525. If we hit our stop, we put our stop at half of that investment, right? So 525 divided by 2, something like 263 bucks at risk if it flips down to our stop. Obviously, gaps can make a bigger gain or sometimes a bigger loss if it gaps the next morning. But we're looking for things that we think can gap quickly in our favor. We got a little gap up the next morning, but it doesn't get there on the first day. We hold it on the 24th. But then you see we do gap up on the 25th. So we gap up to basically come right back to those recent highs up near 616. You say, well, what do we buy? We bought a 603 strike call. Remember when we bought it, we were at 601. We're about 2 points out of the money. And then we went from 2 points out of the money to up to, could have been 13 points in the money. We were out before that full move up on that second day because, of course, we're looking for a double. So our targets are already out there to anytime we get a double on the strategy, take the money and run. cash it in, ring the register, and back to the sidelines we go. So the idea here is that we're using the example on all the charts I'm going to show you that we would base on, say you put in up to and no more than $1,000 a trade. In this example, that only gets you one contract, right? Because if it's over 500 bucks, if it's 500 bucks or less, we get two contracts at least. In this case, we only get one contract. That's fine. We don't get our full allocation. If you're allocating more, if you're allocating 5,000 bucks a trade, then you'd get more like 9 contracts in and be closer to a 90+% of your allocated money invested. In this case, only about 53% of our money invested that we hope to get invested. That's okay. That's just following the rules of not overcommitting your capital. So that makes us 525 bucks before commissions. Oh, by the way, commissions are the best they've ever been in my 36 years of options trading experience. Now it's $1 a contract in, at $1 a contract out some places. Some other places aren't even charging you closing commissions now. So the broker price wars have been phenomenal. So we're talking about one contract in and out, $2 round trip. So you net out 523 bucks on a single trade 2 days later. So we're going to show you a bunch more examples of how this works, but we're ringing the register middle of that second day. We knew we'd be out by the end of that day regardless. We'll look at some winners. We'll also look at when we get stopped out. But here's some other examples of winners. Now here's your classic kind of oversold pattern. This is just one of our 2 bullish patterns. Because I'm also going to show you how we trade overbought markets and can stay with big uptrends too with the %R indicator, the BigTrends way. But this one, you can see here, we're coming off of that low and we are actually rallying back up into, you see at the close of that day on January 23rd, %R is rallying back up somewhere in the neighborhood of about its 80th percentile. It's not at the highs, right? But it is closing here not too far away, just over 622. You see, we're buying a near the money 623 call. We're paying $441 a contract. And oh, by the way, this was called out on a Friday. You say, oh, you'd buy an option into the weekend? Yes, it's the same thing. We're going to buy 3 days till expiration. They're priced accordingly. So basically, we're buying out to the following Wednesday's expiration, in this case, January 28th. So again, we're not going to hold it past the 27th. And you can see we get in there at 441. That would get us 2 contracts in for 882 bucks. So we're expecting, when we see actually these strong closes on the Qs on the daily price action, these of course are daily candles. So we're talking about something where we're closing up the top part of the range and we've actually had a nice little reversal off of it, opening lower and then flipping back up to close even above the prior day's high. So we got some different rules based on opens and closes combined with the %R reading that say, you know what, if it's a strong market and we get this positive finish, that can actually lead to even more positives to come, believe it or not. So the idea is that we are fine to trade a %R, higher %R reading like 80% or even 90% if we're getting strong daily action at the end of the candle compared to where we were earlier. So this means you don't overreact. You don't buy early in the day. You don't get flushed out like a lot of other traders do off the open. You wait until the end of the day and then you see how the market's finishing. A lot of times the first hour of the day is often called amateur hour, where a lot of newer traders and investors will put their stops off of a prior day's low or from the previous close or whatever, get flushed out in the morning, and then it flips back up. A lot of pros will be acting in the final hour as they see the tone, and the tone of bull trends typically is lower opens and higher closes, or if it opens higher, if it keeps going higher, that interests us on a bull trend. If it opens up and then finishes down, that does not interest us, okay? So we're looking for continuation momentum. We want the trend to be your friend. We're not trying to be heroes. Typically, we're not going to call an absolute bottom or an absolute top, okay? We're looking to really catch that sweet spot momentum in the middle. So you see, we open a little bit higher than on day one, we trade higher, but it's day 2 where we gap up, trade even a little bit above those highs. Notice what we bought. We bought a 623 call near the money. We needed that 441 to turn into 882. It did. You can see that would imply it was up around 631 and change if we had no time left, but of course we're up in the 630s and we still have another day and change to go before these options would expire. So there's some time value left. So we're able to get that double, ring the register, make the 882 bucks of profit, minus your 2 contracts in and out, $4 round trip commission. So again, you know, nice when you can do that. And that's why we give this strategy 2 days, not just the next day with the Qs, because of course you can see we're on the right track, but needed some more follow through into day 2. Sometimes it'll happen even faster. Now this is more of a classic oversold signal where we were back into and actually just under those prior lows. And this is the classic %R snapping down into the oversold area. You see we're on 30% on %R at the end of the day. That's because we had some prior lows before the left side of this chart that were part of that percent R calculation. We see we were about 608. We'd had a lot of volatility on that gap down, and you can see why would we buy a gap down? Because our system says we've been in an uptrend, we're getting a short-term snap down. A lot of times you've seen it, and even just recently you've seen it, we get the snap down on the Middle Eastern fears, oil fears, et cetera, and then you see the snap up when there's even just a hint of relief, right? A hint of backing off. And so the snap down markets can snap back very quickly. In this case, we recommended the 610 calls, a couple points out of the money, paid an average entry price of $4.50 for our subscribers, $450 a contract on January 20th. Remember, we're buying out 3 days till expiration, so we're buying the January 23rd expiration options, knowing we'd be out by the 22nd. We get that huge rip back up to basically fill the gap. You know, all gaps don't usually get filled that fast, right? So we're not really betting that it has to fill that fast, but we are expecting we're going to get a grind up over those next couple of days to give us a good chance to double. It actually happened in the middle of that very next candle on the 21st, running the register at $900 times 2 contracts, $1,800 exit compared to our $900 entry. That's a $900 profit minus your $4 commission. And again, we're very happy to take that money and run. If it keeps going on further, congratulations to somebody else. You know, we're just looking to take our piece out of that move, make that double back to the sidelines. If it hits our stop at 50%, we take that 50% give back to the sidelines. Otherwise, we wait to the end of the second day and we time stop the trade out, whether it's a winner or a loser if it hasn't hit our target or our stop. So here's another one back in November where we came down into that actually 20% area, under the 30% region here. We're about 20% in mid-November, a week before Thanksgiving or so. You can see we're finishing the day around 596. So this is another one where we like that we were flipping back up off of those lows, and that, you know, we'd been in an uptrend and we were recommending up to buy a little bit further out of the money, in this case, the 605 calls. You can see that was on November the 18th. So we're buying the November 21st expiration, paying $410 a contract. You say, why do those seem more expensive? Why do you have to go more out of the money? Because we've had that slam down. We were just at 625 up here, and now we've come down to under 595 on the day we got in, closed at 596. So we're down, you can see some 30 points in the Qs. That's almost 5% give back in about 5 trading days, or 4 follow-through days, right? So the idea is that is getting people's attention, going, whoa, what's happening here? So volatilities do start to spike up. So that's something we try to factor in, is to say, okay, based on the typical average true range, the ATR as it's called, that's factoring in what's the range between high and low, and also factor in the gap. So if you were looking at, say, when this move got started on the downside, the close here, and then we actually open lower and then trade even lower, this would actually put a ATR calculation would say, you know what, you need to measure it back to the prior day's close and say your width of that day's range also has to encompass from the prior day's close if you get a gap. So ATR actually factors in even more total price movement than just looking at high-low ranges, okay? So that's what's effective about ATRs, and includes the gaps. You see the total movement, not just the incremental movement on each candle or bar. So 410 a piece, that would get us in for 2 contracts at 820. You can see we got the gap up on day 2. So we closed the prior day about 600. We made a little bit. You're kind of feeling like as it reversed back down off of that first day high, up near 605, closes near 600, you're like, oh man, we've lost a little momentum. Well, our system says we're coming off that oversold range. You can take up to a couple of days for those snapbacks to happen in our experience. So we actually gap up here at about 611, almost 612. We have the 605 calls. They're about 7 points in the money, and they have almost 2 days of time off that gap open before they expire at the end of the day the following afternoon. So we're out at the open and take the double and run. $824 total profit in that example. Again, past performance never guarantees future results. We will have winners, we will have losers. And we'll show you what a loser looks like here as well. But here's another strong trend example, right? So you see that percent R staying above that 60 level, and as we start to come up here just around the 80 level at the close on October 17th, you say, why are you buying here into the old highs, right? Well, we're saying, look at that reversal, right? Where we open lower and flipped back up. My late friend Steve Bigelow called that a J hook, and I always loved that description, right? It looks like your hook on your fishing rod, but the idea is that, guess what? The bears have gotten hook that is faked out on the downside earlier in the day, and then the bulls are retaking the ball late in the day, right? That's what we like to see, to say, okay, that strength of market combined with that positive price action finish is usually, we think, a really good sign for follow through into the next morning. So what you most want to happen with this QQQ options playbook strategy is to catch the gap the very next day after you get in that prior afternoon. But the beauty of getting in that last half hour, in this case on the 17th, is the earliest we can, that was a Friday, by the way, the earliest we could get out is the next trading day on Monday morning. And again, we're not afraid to hold over the weekend, right? You'd say, well, now with the Middle East, should you still do that? Our system says you should do it regardless and take advantage of these setups and know that you've got stops in place, you've got price targets, and you let those overall rinse and repeat over a longer sample of trades. No one trade should ever be a make or break you situation. We want you to start small and build. But here we did get the follow through gap the next day, got a little extension on day 2, but you see we didn't get far enough. Right, so we went from about just under 604 when we got in and bought the 607 calls, paid $391 a piece. That gets you 2 contracts in for like $782. If you're putting in $1,000 maximum, can't get that third contract to push you out to almost $1,200. So 2 contracts, $391 a piece. Next day you're feeling pretty good. It goes to 612. It's about $5 in the money. We needed it to probably go up towards 614 or so, maybe 613. Didn't quite get there, right? So day 2, guess what's happened? It hasn't really gone up that much more. It's kind of flattened out as we're getting out here in the afternoon there of day 2, near maybe 611, about $4 in the money. We're closing it out at 538. But here's the key. We didn't hold in hope, since we're only up 37.5%, we don't hold in hope and hope that we get bailed out on the expiration day. If you do that, you're toast, right? If you hold it into the close of the expiration, look at where it finishes. It finishes at like under 606. Guess what happens to 607 calls at their expiration? Under 607, bye-bye, wiped out. That'd be a total loss if we were passive, okay? You cannot afford to be passive. That's why I've been trading for 36 years and counting, basically, like I said, almost 37 years next month. But the idea is that it's about a proactive approach. Whatever you do, don't sit back and hope. Okay, so that's only $294 in profit, but I think what's more important here is that it avoided the pain of the next and final day of that trade and said, okay, take your window is closed, get back to the sidelines, win, lose, or draw. So the beauty of this method is we're not going to hold anything more than 2 trading days in full. So, you can see here that we'll be in, we'll be out. We're using 2 different bullish %R signals. Our bearish signal is based on a really weakening market. We'll see if we have any of those in here, but bottom line is that when the market's getting real weak, we can take advantage of continuing weakness with the %R flipped to the downside, showing persistent selling pressure. So we're only going to buy a call or only going to buy a put. But what I love about QQQ options is they have every single day expirations. That means every single trade we call out is going to have 3 days till expiration. So they typically have those listed out for the next almost couple of weeks with the everyday expirations, at least the next 5 to 7 trading days. So we can really customize this. We like the daily chart a lot more than an intraday chart because we're really looking at the bigger trends, the bigger opportunities. Where's the bigger money flow happening from the institutions who, let's face it, are driving the markets. So we can send these trade alerts out usually between 3:40 p.m. up to 4 p.m. Eastern. You say, hold on, doesn't the market close at 4? QQQ options keep trading until 4:15. We usually like to give you at least a half hour or so to get in, but if we're real close, not quite on the bubble of getting a validated signal or not, we want to make sure you don't miss a valid signal if it's happening right into the close. And then you still can just matter of getting a real-time email from us as well as getting real-time text alerts. I do recommend setting up the text as well. No additional charge from us. So basically you never miss an entry or an exit instruction. Power 3 DTE options, we're not trading 0 DTE. There's plenty of leverage here and not having to mess with that final day of the options life. Plenty of trade frequency as well. We would expect to average probably about, maybe a couple trades a week on average with this system. So bottom line is that it gives us a lot of leverage. Look at our average contract entry price since the beginning of 2023. $3.46, $346 a contract. That's almost 3 contracts per trade. Like I've showed you some examples here where we only got 1, a number of times we'll get 2. If it's under 333 a piece, if you're putting $1,000 in, that gets you 3 if we're using the $1,000 cap. You don't have to use 1,000, you can use less or more. But I always say for new subscribers coming in, your first goal should not be how much money am I going to make on my first trade. Your first goal should be, can I prove to myself that this system's right for me, that I can follow it on reasonable string of trades without any hesitation, without any variance in my approach in executing the trades, right? Whatever you define if you're going to buy one contract at a time, if you're going to buy a set dollar amount at a time, maximum, then you follow that through and you prove to yourself that you can do that. That consistent execution will make you a more confident and a more consistent trader, okay? So the idea here is that there's going to be wins, there's going to be losses, but we will exit after 2 trading days at 3:40 p.m. Eastern if we haven't already closed it at the target or the stop. So this avoids that final day of potential volatility and time risk. You say, how have you done overall? Remember, when we look at a past performance look back, we've got to remind you that past performance never guarantees future results, right? What happens in the future is going to vary. But the key is you've got to have a plan to keep on firing through different market conditions and say, has this worked through a variety of different up and down phases? You can see that if we start with a $5,000 model portfolio and say we're going to put in up to that $1,000 a trade and never grow that amount per trade, even as the portfolio grows, to stay fixed with $1,000, it's not compounded, then we take 5,000 up to over 24,000 for a gross profit of 19,378 through today on all closed trades. So the idea here is that grew 387% gross before commissions and subscription investments. We show you here, commissions are almost a pittance compared to what they used to be, and we're only buying options here, so it's keeping the commissions down. And then we've got a great special for you to take advantage of keeping your fees down as well. So you keep your vast majority of your money working hard for you in your trading account, an investment account. So bottom line is that, we're pleased with that overall growth in a matter of, you can see here, about 3.25 years, right? So we're talking about now coming up on 39 months. So the key is past performance doesn't guarantee future results. So never think that when the system's hot that you should load up, or when the system has a stop or two that you should bail out, or you've got to be able to keep executing. So like we said, the specific setup, actually, we're looking at a combination of %Rs configuration with the price action patterns, the candlesticks, the momentum on a day-to-day basis, and that creates windows of opportunity. There's 3 of the 8 potential combinations there that we really like. The other 5 out of the 8 we don't like, we don't trade those days, okay? So the bottom line is that we're looking at history, knowing that it can't guarantee the future, but we consider it a guide for looking for these patterns. And what we look at is, everybody always asks me, what's your win rate? And that's part of it. But you know what? What's really also important is how big can you win? How relatively smaller can you lose? If we were making 100% gains and 50% losses and doing that every other trade, like in a coin flip game, that would still make you a lot of money if you just consistently follow that type of an approach. But the idea is that, look, there are going to be losses. I want you always staying risk managed so you never get too high or too low. Here's another example from October, which you can see that big red candle on 10/10. October 10th was when President Trump threatened China with 100% tariff added on, which the market obviously did not like. But you can see the overall very strong %R, very strong, basically bull market with that one little shakedown. Okay. So the idea here is there will be shakeouts, but we are not afraid to buy gaps up, right? We see the gap up, and remember what I told you earlier, when you gap up here at the open, I want to know what happens by the close. By the close, guess what? Institutions are still buying into the end of the day. They're saying they still need to be on board. Do you think there's a lot of cash on the sidelines? Of course. There's a ton of cash on the sidelines. All the cash that got built up over the last few years from people who were saying, I like these interest rates being higher, let me sit on a 5%, 4.5% money market yield. Obviously, that's come down now. But and that's actually forcing more money back into stocks, I believe, as it probably keeps coming down throughout 2026. If you look at your federal open market committee meetings to come, they're projecting probably about another 0.5 percentage point or 50 basis points of cuts by the end of the year on average. Now that could change, but the point is, okay, that cash is becoming more trash and pushing more money into equities as we look out throughout this year overall, even through these recent market shakeouts. In my opinion, we'll see how it plays out. But again, I have an opinion. That's not how I trade. I trade based on the setups here. The setup said buy into the close. We're about 628 there, and we're saying, okay, buy the 630 call. It's about 2 points out of the money. $375 a contract gets us 2 contracts in for $750. The next day we pop to 634. You see, it's only about $4 and change in the money, but you see we still have another day and a half left of time. So we're able to get $750 right near the highs of the day, and subscribers book a $750 profit minus your $4 commission at most. So that's another example where %R staying strong, we can still buy calls if we've got the right setup. Now here's an example of a losing trade. You can see this is going back to last August. This is where we have that overall strength in the market. And we like that we've had that little undercut here, which we kind of need to see, and then we have that reversal back up near the top half of the range, top third of the range here. We think that's going to keep on going back towards the old highs. We're just over 577. We're buying the near the money 577 calls, paying 291 a piece. That gets you 3 contracts in for just under 900 bucks. And you see, oops, next day doesn't work. We open a little lower and we keep going down all day. So point being that, look, we have this situation where we need to take the hit when we get hit. At a 50% loss, we say, okay, guess what? We lose 146 bucks a contract times 3. We're losing, as you can see, in the neighborhood of just under 450 bucks. It happens. So when you're shooting to make 1,000, losing 500, it's a reality. It will happen, and I remind subscribers of that. But the idea is that it's about how you stack them up over time. Sometimes you get gaps that got past your 100% target, right? So here's another super strong trend back into September. Had that great finish on that one. Again, I always put an F on these under the prior bar's low the next day, right? That F stands for fake out or flush, right? And you don't want to be faked out or flushed. And so that's why I say don't overreact interbar. Look for what happens by the end of the day as we're putting this trade on. It finishes right near the highs, just around 600. We're buying the at the money 600 calls, $3, 300 bucks a piece. It gets us in for 3 contracts at 900 bucks. Here's the key on why we use a 50% stop. Look what happens on the next morning's open. We open lower. We didn't get the follow through that we expected initially. Open lower. Oh, by the way, it's almost flushing some people again, but it doesn't quite undercut those prior lows, but undercut the day before that's lows again. But the idea is that, look, we trade down to almost 596. Remember, we got in at 600. Guess what? At that point, when you're down 4 points on the Qs, or about 2/3%, you're going to be facing probably a 30, 35, maybe even 40% loss. If it hits 50, we're out, but that's why we use 50 and not 30, not 20, 30, or 40. And also because we're targeting doubles, twice of what we're risking. So the idea is that that keeps us in the game. So when it does have that huge reversal up, and then of course with that huge reversal up, if we hadn't had a signal there, we probably would have had one at the check mark at the end of that next day, but we already are in, so we don't double up, but we get the open the next day further to the upside near 607. We're ringing the register beyond our $6 price target. We're out at 731, 143% on that. Obviously that's an outlier. If we get 100% or we're below 100%, we trade up incrementally through it intraday. We will take the 100% to double every time. But if it gaps past there, we take that too. That ends up generating more than our $900 expectation. It generates $1,293 minus your $6 commission. So how can you get access to our QQQ options playbook strategy? I'm a big believer that you need enough time to try something, but not too much time. So basically, I don't even think a month is the right amount of time to set it up. So what I've done, actually, if you looked at our BigTrends website, our QQQ strategy is actually sold out on that site, but I've reserved a limited amount of spots as Dave and the festival have been really good to me over the years. So bottom line is that we set up 27 spots with a super discount to try it for 3 months, the next 90 days. You know what the market's done here recently. It may have made you gun shy or skittish about the market. This is the time where you don't want to be skittish. This is the time where you want to be ready to keep capitalizing on volatility, on snapbacks, on opportunity, as well as if we do fall through the downside, we'll get some put trades. I mean, so we're going to get opportunities in both directions. But bottom line is that what we're looking at here is that as a 3-month trial here, you do have to put a little skin in the game, but we're going to save you a bunch off of what you would have paid if you could have bought it off my website. That we're going to give you all the same educational benefits we give to long-term subscribers, which we have a lot of, many hundreds in this service. So the idea is that, look, that's why we have to limit the spots, right? So, but the queues are very liquid, so we're not too worried about 27 spots to come here, but we'll shut it off after that. You get the settings and rules. Part of your terms and conditions when you sign up is you're not to share that with anybody. I've worked for years and decades developing these kind of methods along my team. So the idea is that we want to make sure existing subscribers keep their edge strong. I also do weekly video training on the queues and the markets here. And then also you get a dedicated email to reach me and my analyst team if you've got a question about why we called out a trade. If you're not clear on it, you can always send us an email. Like I said, if you were able to buy it on my site, it'd be $297 a month times 3, $891 you'd be in for the next 90 days. Slash that, we're slashing it by some 80%. We're taking it down from $891, cross that out. taking it down for you today by more than 700 bucks off to just 177 bucks. That's a little skin in the game for you. Yes, you have to make a little commitment. I think that's a commitment that's well worth it. When you think of one trade, if you're investing $1,000 a trade, has a potential to double and make you 1,000 on a single trade. If it happens to be like that first example I showed you, where I only made 525 on one contract, hey, that's still giving you like a threefold ROI in that type of example too. There's going to be losers though too, so don't get loading up on your first trade. Be consistent in your execution. This should give you about a couple dozen trades over the next 90 days to allow you to start to prove to yourself that A, the system works for you. Don't just take my word for it. Try it yourself, watch it yourself, and trade it yourself. And trade it small at first, and then let the system prove it to you that it does what I'm saying, that you can stick with it and that you can continue to stick with it after the 3 months are up. What's your pricing after 3 months? We give our best pricing to existing subscribers, so don't worry about that. We'll give you a ton of value to extend your subscription and become a long-term subscriber after you try it for these 3 months. So all you do is go to bigtrends.com/festival. I'll just quickly show you, I've got a few more minutes here, so I'll quickly show you what that page looks like. All discounts have already been applied. Okay, so we make it really easy for you. No other promo codes can apply here. This is 177 bucks to try it for the next 90 days. If you do the math on that, that's just under $2 a day for the next 90 days. So the idea is, and like I said, a couple dozen trades, you see that you can get your money back and then some on just one reasonable winning trade. Okay, but like I said, don't look at it just on a trade by trade mentality. Think about it as building the habit of consistent execution. How do you get started? We've got our payment info here if you want to put in any of the major credit cards. This is a secure page, of course, and all your billing information over there. If you want to save a whole lot of typing, you can use PayPal as well. You can just review terms and conditions in any case, and then hit the I agree button on how we've done business now in our 27th year serving our BigTrends community, and then click through to PayPal or put all your information there and complete your purchase on that page itself. So if you've got questions, note that you can also call us. That 800 number spells out to 1-800-BIG-TRENDS. That's an easy way to remember us. We're BigTrends.com, 1-800-BIG-TRENDS, or 800-244-8736, or just remember 1-800-BIG-TRENDS, or make a note of it now. And you can email my customer service team as well via clientcare@bigtrends.com. Like I said, you get a separate analyst email as well when you get signed up as well. So bigtrends.com/festival is your ticket today, saving more than 80%, more than 700 bucks off of the usual 3-month pricing. Yours today for only 177 bucks when you go to bigtrends.com/festival. I want to thank Dave for having me. It's always a pleasure being with you, and there's lots more great fellow traders to come, so stick around for them as well. Thanks, Dave, for having me, and look forward to seeing a bunch of people taking advantage of this QQQ option special.